This is a download from BFM 89.9, the business station.
Alliance Bank presents you The Breakfast Grille. Top interviews you can't afford to miss on BFM 89.9, the business station.
On The Breakfast Grille today, Marc Faber, investor, financial commentator and author of the GloomBoomDoom report. He predicted the rise of the commodity bull run in the early 2000s, and today we will discuss the current global investing climate and whether there's hope after the emerging market currency rout. Marc, good morning. Can we start with China? They devalued recently by 2% of the currency, and the stock market there had been on a roller coaster ride. And you think that China is a threat to the global economy. Have the Chinese problems dominoed into the rest of the world?
A number of economists have downplayed the importance of the Chinese economy for the world. But to that I respond that most of the growth in the last couple of years, especially after 2009, after the crisis, was due to the expansion, the rapid expansion of the Chinese economy. In addition to that, we have to see very clearly, whereas China consumed just 5% of global commodity consumption in 1990 and 12% in year 2000, by now it's almost 50%. In other words, a lot of growth in the demand for commodities that also drove up prices after 1999 was due to China. What it did is it boosted the economies of the resource producers, Australasia, and by the way also Malaysia, and Africa, Central Asia, the Middle East, Russia, and Latin America. And now that at the same time that these economies were boosted, in other words, they expanded as a result of more demand for their commodities and rising prices, these countries had more purchasing power. So they went around the world and bought capital goods and also consumer goods, mostly from China. China today is the largest trading partner of over 125 different countries, whereas the U.S. is the largest trading partner of just 74 countries. So we can see a lot of trade developed as a result of the China boom. Now, the Chinese economy has slowed down very meaningfully.
So, Marc, people say that the U.S. economy is on the mend. Will U.S. consumption save China and save the rest of the world?
Well, as a country, the U.S. is the largest trading partner, but it's not much larger than the EU. And both the EU and the U.S. are smaller trading partners than all other commodity producers in the world. In other words, the Chinese economy has a huge impact on other emerging economies. Now, about a year ago, I started to argue that the Chinese economy was growing at maximum 4%. I think by now it should be clear that it's growing at maximum 4% per annum. You cannot trust the statistics published by the government. But if you look at exports, you look at car sales in China, all down. Railway traffic down, and so forth. So the Chinese economy now is not performing as well. The result of that was collapsing commodity prices and recessions in countries like Brazil and most likely also Canada, Australia, and other emerging economies that produce commodities.
So if we look at what China is doing recently, they have tried to announce some stimulus package. And the question is, can they spend their way out of trouble? Because they have a very low debt to GDP. And according to statistics, they are among the top 5 in the world for national wealth.
I'm surprised you said that China has a low debt to GDP. This is precisely one of the problems that credit as a percent of the economy after 2009 has exploded. and total credit as a percent of the economy is now approaching 300%.
I'm just referring to government debt to GDP and not...
Well, the government debt to GDP, we have to break it down in local governments, in the state government and so forth, and in state-owned enterprises. I'm referring to total debt. It doesn't matter really where the debt accrues. It's better it accrues in the private sector than at the government level for productivity. But basically, the total credit as a percent of the economy is very high.
What about China's FDI? According to official figures, which you may not trust, but officially they are hitting about US 120 billion a year compared to below 100 billion from 5 years ago. What does this mean about long-term investors' confidence on China?
Well, foreign direct investments and capital spending is a lagging indicator. And I think if I look at the results of U.S. technology companies, at car companies in China, where sales have recently all been disappointing, and that's why a lot of these companies' share prices have collapsed in the U.S. and in Europe. If I look at that, then I think going forward, capital spending in China will slow down. I'm not predicting that China will no longer grow in future. I'm just saying that as an economist, grow, and there is a boom, and then there is a recession. And if you don't believe that there are ever again recessions, then the discussion is basically superfluous.
On the Breakfast Grille this morning is Marc Faber, influential investor who predicted the commodities bull markets in the early 2000s. Coming up, Marc's views on the Chinese devaluation as well as the commodities situation. This morning on the Breakfast Grille is Marc Faber, economist, market forecaster and publisher of the GloomBoomDoom report. Marc, let's just go back to China and what they did with the devaluation recently. They are striving for international acceptance of the yuan. Do you think that this devaluation has sort of thrown that objective out a little bit?
Well, basically, the IMF said recently that the issue of including the Chinese yuan into the SDR basket would have to be postponed. But I don't think that the recent devaluation of the Chinese currency has much to do with it. I would rather argue that because of the extreme slowdown in exports in China and the economic weakness, the Chinese being faced with other Asian countries that had devalued their currencies massively, in particular, obviously, the Japanese yen, that they decided, okay, if the others do it, we'll also do it. Now, I also have another view. I think that central bankers all talk to each other. The Bank of England talks to the Fed every day. The Fed talks to the ECB every day, to the Bank of Japan every day. And I wouldn't be surprised if they also talked to China, People's Bank of China. And in this situation, I would argue the U.S. may have actually had an interest, or the Fed may have had an interest for China to devalue somewhat. Why? The reason is that if China's currency starts to slide, it's negative for the U.S. economy. And that gives ammunition to the Fed not to increase interest rates in September.
And you are of the opinion that the Fed does not want to go towards that position of raising interest rates?
My view is that contrary to what people say, the U.S. economy is weakening, not strengthening. There are many headwinds in the U.S. One of them is affordability, that people simply don't have the money to spend because taxes went up, housing cost is up substantially, because now an increasing portion of the population is renting, and rents have been going up substantially. And under these conditions, I don't think that the economy is strengthening at all. Then you read the results of American corporations. Revenues are basically down year on year. The overseas earnings are down. Capital spending picked up somewhat, but now is stalling again. So where will the economic strength come from?
So if we see the behavior of the recent devaluation of a few percentage points, this actually is very small compared to the magnitude of the US dollar strengthening of, against a basket of goods of around 16 to 20% over the last 5 years. And not to mention the emerging market currency weaknesses or very sharp fall, and we see it in the ringgit too. Does this mean that China will have to continue to devalue further?
In my opinion, devaluations do not help in the long run. Countries that have done economically well in the past had strong currencies, not weak currencies. And this devaluation game may help for a little while, but not for the long run. I hope the Chinese will not let the currency decline significantly. But you understand, the world is run by a bunch of professors and academics at central banks. And these people, they have a very simple view of how to plan. They're basically central planners. They think higher government spending is good for economic growth. There's no evidence whatsoever, as Milton Friedman showed, in this belief. Secondly, they believe money printing is good. It stimulates the economy. And thirdly, they believe that a weak currency will help. Now, in the case of Japan, what the weakness in the yen has done, it's lowered consumption and it has diminished real incomes of people and the national wealth. So I don't know why people would think that a devaluation is good. It's a very bad thing to happen. It only helps you temporarily. The whole world is now up in arms because China let the currency slide a little bit, not much. And they overlooked the fact that in the Asian crisis, 97, 98, the Chinese currency stayed strong. They didn't devalue and all the other currencies devalued. Secondly, as you pointed out, this year most Asian currencies are down significantly. I think the Malaysian ringgit probably in the order of 15%, and Thailand is down 10%, and so forth and so on. So I think the Chinese, they just reacted to other countries' currency weakness.
So if we are to go with your theory of some kind of financial engineering going on between the US and China, what would be the payoff for China for doing this? Would they be gaining a lot more prominence in the international scene as far as the yuan is concerned?
No, I mean, I don't think there is a payoff for anyone, but as I said, the world is run by central bankers who have certain beliefs. I don't believe in that, but the central bankers, they may argue, well, now the Chinese have devalued the currency. This is bad for the U.S. Now we cannot increase interest rates. In other words, the Fed that has kept the Fed fund rate near zero for the last 6 years, now they have an excuse not to increase rates.
We are speaking this morning with Marc Faber, investor and financial commentator, as well as author of the GloomBoomDoom report. Marc, currencies from Malaysia to Mexico, Indonesia to India have weakened sharply against the US dollar. You run a few emerging and frontier market funds. Are you having more sleepless nights right now?
No. If I have sleepless nights, it's because I'm in a nightclub, but not because of my investments. And I would say I'm a believer in investing in emerging economies, and I actually also have investments in Malaysian stocks. And over the long run, I believe that they will outperform U.S. equities because at the moment, emerging market equities are not yet at a bargain level like they were in 2009 or after the Asian crisis in 2001 and 2003. But they are reasonably priced. Let's say my long-term return expectations from emerging economy stock markets would be around 5% per annum. But in the U.S., I think the market will not return satisfactory return in the long run.
Now, the economic openness of emerging markets have resulted in these destabilizing flows that result in their weak currencies. Does this support the idea of more capital controls for coming from emerging markets and a result make emerging markets investments more risky?
I don't think so, but you have to see the monetary policies of the U.S., which was essentially aimed at creating the Nasdaq bubble and then creating the housing bubble because they thought that this would help the economy. And by the way, this is one of the greatest economic fallacies that has been propagated. But this money printing in the U.S. led to overconsumption in the U.S. and the growing trade deficit of the U.S. And it led partly to the commodities boom. And so it led to boom conditions essentially around the world in countries like Russia and Brazil and even Africa, Australasia, and to some extent in Malaysia. And once commodity prices go down and once global liquidity tightens, and global liquidity has tightened because the American trade deficit has come down largely because of the oil production in the U.S. And so the global liquidity is tightening, and in this environment, emerging markets do not perform particularly well.
Would Malaysia be somewhere that you put your money now, and what do you think of what's going on right here, right now?
Well, basically, Malaysia, the stock market is, of course, down substantially in dollar terms since May 2013. In dollar terms, we're down 30%. The ringgit has lost something like 30% from its peak. And so the market has adjusted significantly on the downside. I don't think that it's yet a buy. I think we will probably go somewhat lower. But I'm still a believer in the long-term potential of Malaysia, and I would essentially look at Malaysian stocks to enter at the present time kind of a buying range. I don't think that you'll make a lot of money out of Malaysian stocks in the next 2 years or so, but on further weakness, I may increase my positions again.
On another note, as far as commodities are concerned, you had been very positive in the early 2000s. And you also, as far as gold is concerned, called for a 30% rebound this year. It hasn't happened yet. In fact, gold has fallen from $1,200 an ounce to about $1,100 right now.
Yes.
What do you think is the next move for gold and commodities in general?
Well, basically, I wrote the book, Tomorrow's Gold, in 2001. But it wasn't specifically about gold, but it was about the rise of China and Asia and emerging economies as a percent of the global economy, and basically the rise in commodity prices. Being negative about the Chinese economy, I was obviously no longer positive about the industrial commodity prices. I'm somewhat surprised that gold is down. It doesn't hurt me. And actually, I would use eventually this weakness as a buying opportunity. I buy actually gold every month somewhat because I want to have some money outside the banking system. And looking at central banks around the world, I don't believe that we are in a currency war, but they are passing each other the baton. You know, the U.S. prints money, then Japan prints money, then the EU prints money. It will go back to the US. And in this environment, you don't want to own too much cash because cash will lose its purchasing power over time.
In connection to that, it came as a surprise that China's gold reserves was below expectations, only at 1,600 tons compared to 1,000 tons a few years ago. Will China and other central banks in the world start to accumulate more and more gold going forward?
I think the Chinese may have understated their true reserves. And I believe that both wealthy people around the world and institutions, also sovereign funds, and central banks in Asia will essentially accumulate gold. Now, this doesn't necessarily mean that the gold price will go up, because one of the characteristics of gold, platinum, silver, and so forth is that it doesn't rot. You understand? If you produce soybeans or coffee, then that is consumed every year. So the supply essentially disappears as a result of the consumption. If you buy an ounce of gold today, you're not sure where it was mined and when. It could be gold that is 1,000 years old. You don't know. So I would say, even if there is buying, it doesn't necessarily mean that prices will go up. But if I look at the price of gold in the world compared to global debts, then I compare it to global money supply and so forth, then I think that the price is now again reasonable.
We're speaking to Marc Faber this morning, a global investor, on the state of the world. Now, you give advice, Marc, to the big money. How should a small guy invest to sustain a future?
Well, I think small investors have some disadvantages and advantages vis-a-vis large institutions. If you're a fund manager at Fidelity or Capital International and you manage billions, say 10, 20, 30, 50, $100 billion, you cannot buy small companies. So your limitation is that you have to invest in essentially large market cap stocks, and large market cap stocks tend to be relatively expensive as a result of this institutional money flows. So the individual, he can look at small companies. Frequently, small companies are very good. They have high dividend yields. They have good management. The management are the owners, so they have an interest in the long-term growth of the company and so forth. So that is an advantage of the small investor. The disadvantage the small investor has is that he has to live with a lot of volatility, which is caused by the big boys, the high-frequency traders and so forth and so on. But if he can live with this volatility, I think he'll do quite well.
Now, there is a lot of discontentment in the world right now. Inequality is on the rise. Do the rich and the 1% class have to think of ways, do you think, to even things up a bit? And do you foresee the kind of public uprisings along the lines of, the Arab Springs across the world?
Well, the thing about wealth inequality, and I've done a lot of work about this, and when I first started to write about it in 2005, some of my readers accused me of being a socialist. I'm not a socialist, I'm a capitalist, an extreme capitalist. But I focused on what causes wealth inequality to rise. And it leads me back to central banks' money printing. Say you have a society, and that society has, say, 10% of the population. They own properties, they own stocks and so forth, and 90% they work, they're middle class, they have little savings, they hardly own any shares and very little properties. Now you print money. Who benefits the most? The money printing creates asset inflation. Prices of properties go up, the price of rents go up. So the property owners benefit from that money printing, and the people that own the shares, they benefit the most. And so in each period of money printing, and I studied this money printing exercise very carefully, A, through the economic literature, and B, I traveled frequently to hyperinflation countries like Latin America in the 80s. And in each case, I could see that money printing polarizes wealth dramatically in the hands of very few people. And I make central banks directly responsible for the rise in wealth inequality.
Thank you very much. That was Marc Faber, global investor, economist, as well as publisher of the GloomBoomDoom report on this morning's Breakfast Grille. And if you want to catch Marc Faber, he would be speaking at the World Capital Market Symposium, which is organized by the Securities Commission, and that's happening on September 3rd and 4th. I'm Julian Ng, BFM 89.9.
The BFM Breakfast Grille was brought to you by Alliance Bank. Banking made personal. A total banking relationship that rewards you.
Thank you for listening to this podcast. To find more great interviews, go to bfm.my or find us on iTunes. BFM 89.9, the business station.